Right. Welcome. Here we are at Burn Rate and Beyond. This is episode number 12. My name is Chad Fultz. I'm here with the ever smiling Jeffrey Mazza.
Hey everybody, how are you?
And today we are talking about mergers and acquisitions readiness. That is the plan. So I guess let's dive right in and see what we got going on today. So my first question is M&A, mergers and acquisitions. What is the technical difference? Because I understand there's like a little bit of a merger, complete takeover. Not I kind of understand the extremes, but what's the technical difference between the two?
Yeah, and I think everyone is familiar with those terms, right? Mergers, acquisitions, M&A activity, but I think from in simple forms, right? I mean, a merger is obviously when the two companies kind of combine together, that forms like this one new entity, taking two and making it into one, where as opposed to an acquisition where one company will take control over another. Usually that acquired company doesn't cease to exist, but the company that is taking it over, it's the new owner, of that. So those are the kind of the two differences there.
Yeah, and I guess I asked the technical difference because I feel like there's people who there's a whole concept. I think a founder wants to exit. Okay, so what does exit mean? What is their exit? Like, lots of people just sort of say that as like this general term, and in reality, we're talking about M&A, but there's a bunch of different formats, I guess. And I guess that's kind of what I was thinking. Is like, okay, do both qualify as an exit? You know?
Well, I think if there was a merger, and sometimes it might be like, hey, think about it, right? You have two owners, they come together, and you can have or two CEOs or two presidents of some sort, but there's should be only one. Maybe there's a co for a short term, but I think the person who is looking to exit in some sort of deal structure is to say, maybe I'm here for a couple of years and then I'm out. Or maybe that person is out right away and he's done or she's done, and at that point. But an acquisition, is usually the acquiring company takes it over. They become the new owners, then the new president, and the person that was that target company is now, I'm out. And there's different structures in deal, right? Like you said, right away you're out. Here's a cash up front. There's different deal structures and earnout. They have to stay there. I mean, I think it depends on the deal itself, but yeah, there's a difference there. But when that person is out, I think that can be worked into the structure.
Yeah, because that's the thing. Yeah, I just want to exit. What's the exit? What's the plan? What's the off ramp? How can we get there the fastest?
Exactly.
But yeah. So but I guess the long story short is that there's nuances, and the CEO or the founder of the company that's the smaller company could stay on indefinitely in either case, right? Where it could be that they're merged and they just take on a new role like a CTO, or they become the new CEO, or if they're acquired, then they just take on a different role. It could be short for a specific period of time, for an indefinite period of time. So, all right, well, good stuff. So I guess we're accountants, so we're here talking about most of this is from the point of view of accounting. So the first question is preparation of the financial statements. What is important when you're preparing the financial statements for an event like this, a merger or an acquisition?
Yeah, I mean, I would say like all of them, right? I mean, think about like the other side where there's a buyer that's coming in looking at a potential purchase of a company, right? And then during that due diligence process, it's let's go through your financials and ask for information. And let's say that person that starts sending over information, you're like, these are kind of a mess, right? It doesn't give you comfort as a buyer or an investor to know that these financials are not, say, pretty, they're not tight shipped, not clean, because it kind of can make nervousness, right? Because the person that's buying it doesn't know how performance-wise, like, is this a company that is performing? Is it not performing? But so for me, it's having all financials really in that clean, buttoned up, GAAP compliant, that really kind of gives the comfort knowing that these are clean, that these numbers are accurate to really give us a good perspective on how the business is performing.
So accurate financial statements, everything, have it all nice.
Yeah, and that even goes to like just documents, right? Because not even just financials, but support, having good processes. The more tightened up that ship is, the cleaner that process is, the comfort, and the faster a sale could happen, right? I mean, I've seen those things go south after it takes a long time. Things aren't buttoned up, and it's just, deals can go south very fast. Just
I see. So the potential investors, if they don't have the records aren't clean, and the company that's getting acquired takes too long to clean up their act, then the investors are saying, no, we're out because you guys are a mess.
yeah.
Interesting.
Because the cleaner it is, right, it's like you're going through all the documents, doing your due diligence, right? You're trying to find, is this a good fit for us? Is this company going to make money? And you're going through, but if it is kind of a mess, right, I should say, you're not trusting these numbers. You really don't know if this is going to be good. Like, you're just going to buy this company for X amount of money and realize, hey, we just bought a bunch of garbage right here, and nice terms.
So I was saying garbage, like, what is garbage? Right? Anyway, that's a whole other conversation. But I guess the nuance as I look at it is the challenge of the financial. So one thing I guess the nuance is I was going to go for now is GAAP, right? So GAAP is like this traditional, generally accepted accounting principles. That's the way accounting is, supposed to be done. And I see a lot of small businesses who kind of do it themselves, and they're like, we don't have time or money for that. We just need to focus. We're focusing on the product. We're focusing on the customers, and the money that's in the bank. And then GAAP, well, we can worry about that when we're a Fortune 500 company, right? And is that really the case, or is there a little bit of gray area there, or is it more cut and dry?
Yeah, and I think there is some gray area, right? Because not every company. I mean, you look at like cash accounting, GAAP, accounting, but think about like the comfort that someone, you're like, hey, I want to buy your company. Here's a nice kind of presentation. Here are the financials. They're very buttoned up. They're following, GAAP procedures. And it makes you comfort and gives you a good, kind of indication of not only how much to pay for the business, but is this a good business for this, acquiring company to take on? Maybe there's a discount too, right? I mean, we're not following GAAP and we're just doing our own things. Well, we don't trust this, so we're going to give you a little bit less. We'll give you a little discount because we're not sure what we're walking into, right? Seen that as well. But it's just if there is that sale that's on your mind, start following these processes, now, so that when that time comes, it's not only going to add more value, it's just going to be a smoother process.
The other thing is let's just say a company's been around for 3 or 4 or 5 years and hasn't bothered to become GAAP compliant. Like, how far is it? Like, okay, you're saying they should do that. They're start thinking about a sale or an event, and how far back should they go? Should they go back to the beginning of the year? Should they go back to the beginning of time? Should they go back 12 months? Is there a kind of general rule of thumb where you think investors care or don't care?
Yeah, that's a good question, because I think some people show up, wake up one day and say, I want to sell a business. And if they're not have any sort of, compliance or, clean books, and it's almost like, well, that's all you're offering me. And it's like, well, there's a lot here that you need to get done. But when, just from experience, right, back in even public accounting, where joined the transactions group, right? And they're doing a lot of quality of earnings for a lot of hedge funds and private equity firms, all that stuff. And diving in those books, I mean, I think at a minimum like 2 to 3 years, right? Because any sort of buyer or acquirer wants to know trends and try to spot like performance, historical performance. Is this just like a one-off, thing that's happening this year, and now your valuation's going higher, but the previous years were just like garbage, right? Or maybe it's vice versa. We had a great year, and then 2 years later, it starts to go down. Where it really kind of the longer it is, the better the picture to see like the performance of the business and how well it's doing, and is it producing. So I think 2 to 3 years is a good general rule. I mean, if you're around longer, it can't hurt to have more. You can spot trends and identify
Yeah.
some areas.
And I guess that kind of gets into the concept of like a story, right? Because,
Mhm.
I feel like most founders are worried about driving revenue. Like we want to see revenue, and we want to see engagement, we want to see users, and we want to see that, growing exponentially, et cetera, right? But that's only part of the story, right? And I guess there's like, so I kind of feel like there's concept of like, do the financials reflect the actual evolution of the business?
Mhm.
So, yeah, I guess you have any
It is.
thoughts on that? Mhm.
Yeah, I mean, and that's why I feel like it all kind of ties back together. That's such a great point, Brad. Is like when I mean, think about it, like if you are going to invest in a company. I mean, you kind of want to know how the business is doing, right? And that's where the clean books come in, the good processes, right? Because you want to look at those numbers and say, well, what is the story that is being told? And that's really the profitability of the company, right? How is it growing? Is there margin, scalability? Is it healthy, right? And that's something before taking a big dive off that diving board, checking these off the boxes, right? And a lot of times people just want a streamlined business, right? They don't want an owner-operated business. They want to own it to make money and just plug someone in that seat, and then it's off and running. So the more
Ah,
right? I mean, you might find someone that wants to be an owner-operator, but when we're talking about PE firms, I mean, these guys just want to get in, good business, plug in their leadership team, and 3 to 5 years they'll flip it to someone else. And the more of an oil machine that is, the easier and the more likely they want to jump in there. So it's looking at the real story of the numbers.
so it's partially, and I guess that goes to, like when you say they just want to, plug in their managers. It's like that goes to operations to a certain extent, but then but can that be, I guess, does finances always go hand in hand with operations? Could the operations work great, but the finances be poor, or vice versa? Like that's like I feel like they kind of go hand in hand. I feel like.
They definitely do. That's another good point, because I think a lot of times people just look at the financials, but a lot of the due diligence might come in from those operations, right? Let's look at maybe there's metrics and how fast you turn and inventory turns, like just to be able, depending on the business, but even the team, right? You're coming into a business saying we have this rock star operations team, and it's like, well, great, we want them there. We don't want to get rid of them.
Right.
But yeah, to me, they all. I mean, everything's being looked at of the business.
Interesting. Because I feel like there's and I think that that's important to consider, that there's different kinds of investors, different kind of buyers. Some buyers are buying they want to, like, I want to buy a cash cow, right? Like I just want
Yeah,
something to revenue and throws off cash, that's what I'm interested in. Others are saying, okay, I want to buy it today for $1 and sell it tomorrow for 10. And so even if it doesn't throw off any cash in the meantime, as long as I can get my multiple a few years down the road, then I'm interested, because they're essentially buying the product or the IP, right? So there's a little
yeah,
bit of there's different kinds of buyers who are different, interested in different things. Obviously, if it throws off cash in the meantime, that's also good, right?
yeah.
But some investors are okay with just the concept of a growth business. So I guess the other piece is, I guess another concept here in financial statement preparation is compliance, right? Um, and that's, goes back to basically taxes and other legal issues. So any thoughts on how that should be worked out, or is that different from the financials, or?
Yeah, and then that's like also a very important piece, because not that it should be any overlooked by any means, but it's part of the due diligence process as well. is that like, do you owe taxes, right? Is there liabilities that are out there, and even lawsuits? I mean, what are they walking into, right? And the more kind of transparent, the better. But some of those things, are red flags, and it might be like, hey, we're gonna, purchase the company, but you got to pay those taxes beforehand, or maybe it's deducted or something. There's some sort of part of it, that it's in there. So especially the liabilities, looking at their assets as well. So just having those clearly disclosed and talked about, because it's all going to be part. I mean, you can see that on the financials, but it's part of the negotiation for sure. But it's important because those two, like if you're not compliant, and there might be some contingency clauses if those things are, arise after that they weren't disclosed, then there might be some sort of issues there. But for the most part, disclosing them, having them paid, it's part of the negotiation.
Yeah, and it's definitely a good idea to either pay them or disclose them, because they eventually will rear their ugly head if they haven't been dealt with. And
yeah.
that comes back to
Well,
haunt some people.
Yeah, especially buying a company, then all of a sudden, a year later or 6 months later, you're like, oh, you owe all these taxes, and you're like, I didn't know that. I'd be pretty upset myself.
Let's see. I guess you mentioned the word red flag, and I guess there's, as I'm thinking through like a balance sheet, are there any other red flags that would be on a balance sheet, or red flags if something is missing from a balance sheet?
Well, I mean, even when you start looking at that balance sheet, where it's really kind of disclose some sort of a financial health, right? And I mean, you start to see, more liabilities, and I mean, these are like industries are different, but I just think in general, right? You start to see, low assets and high liabilities or negative numbers on there, that it kind of raises the eyebrow of, what is this? Are these financials good, or is that an actual like balance? The number, right? And you start to do some sort of, the math, and even during the QV process, I mean, there's very, very extensive spreadsheets that will dive through working capital and really take a deep dive and ask questions, and to get a big picture there. But also too, looking at those add backs and deducts during that process. If the owner's buying a bunch of personal items, well, that's got to be added back in there, and that the new owner's not going to do that. So there's that type of process. But when you start looking at those financials, those kind of clear red flags, right? And a lot of banks call that tangible net worth, right? Book value is just your assets minus liabilities, should there need to be to liquidate, and that's underwater. I don't know. That's a good.
But that's another interesting concept too. Like, especially for software companies that don't necessarily have a lot of fixed assets. It's just internally generated intellectual property most of the time, right? Because it's the code, the software, and the client list, and maybe some other domains, other intangible assets like that. So that's also a challenge. Actually, that makes me think of a really amazing accountant joke. It says, how do accountants toast to an M&A celebration? And you say, yeah, here's to goodwill. May it never be impaired.
That's fun.
So,
That's a good one.
So the concept of the goodwill is generally what's generated in these transactions, right? So on the books, there might not be any particular assets, because it's all internally generated internal intellectual property. But then tomorrow, the company who acquires it will pay more than what's actually the assets in the book. So, and I guess that's also a concern. Do they need to worry about taxes on that? How does that work out? Which I guess kind of leads me into a second piece, which is what levers should founders be considering when they're negotiating a deal, right? Like, is it all about the money today? Is the payout over time better? Any thoughts on that?
Well, I feel like every deal, as long as that there's like an interested party that wants to buy, an interested party that wants to sell, like I feel like any deal it could be made, right? I think in general, I think again, I could be wrong, but like I feel like older owners are like, I just want my paycheck and just be done and retire, right? And you might add some people that will do that deal, or maybe someone that just says, we want you to stick on for a couple of years to get them up and running, or an earnout, where some of their payout is tied to performance too, over like a 1, 2, 3 years, and then they're officially out, based on the performance. But I think for the most part, I always like to say, if you have an interested buyer and an interested seller, like there's some agreement that could come right off the bat there. And every deal I feel like is a little different in some extent, but I just think that or maybe there's we'll give you more money if you stay on, or maybe it's like I don't want to do that. Just give me a little bit less, and just I want to be out. And I don't know if anyone wants to throw away money, but I feel like anything's on the table in terms of negotiation.
Interesting. So there's no one right answer. It kind of depends on both parties. I definitely feel like, is what I heard you say. I definitely feel like there are some advantages, for tax efficiency. There's different ways to structure a deal from the founder standpoint that will have a material effect on how much tax they have to pay at the time of sale or down the road and globally. So they're not all of them are made exactly equal, but there are definitely some options that need to be. And I guess this is also kind of goes back to the concept of setting up, preparing as well, is setting up a C corp and issuing stock to the founders when the C corp is set up is probably one of the best ways to later on, when you do have a deal and you sell the stock to an interested party, then you can exclude an important portion of you can potentially exclude an important portion of the capital gains on the sale of that stock. But that needs to be set up a certain way. And if you missed it, you didn't set it up that way in the beginning, there's ways to fix it now, but there's a waiting period. It's like a 5-year waiting period that you need to do before you sell that stock. So there's also, you can weigh those back. You can kind of weigh the options there, depending on the timeline and the other interested parties and the deals you're working on. So there's definitely some options, but there's also things need to be set up today if you're thinking about a sale tomorrow or next year or 5 years from now. I guess the other question I feel like has come up a lot is like, how much is enough? You know what I mean? Like have you seen people say, I want, some huge number for my company?
Yeah, I think every owner has inflated numbers in their head, especially folks that have, started this business many, many years ago, and the blood, sweat, and tears, and like, my business worth $1 billion, and you start diving through the numbers, and in a good way of just saying, here's a proper way to do evaluation. We think it's worth this, and sometimes you might get the, upset owners right off the bat when they, kind of gets hit in the face with that like kind of number. But it's when it comes to the valuation, all of it's on play, like, messy numbers and businesses producing this, and, working capital and liabilities, all of that's on the table. They'll go look at me, everything, contracts and, records and compliance, IP, all that stuff. Is there any risks? They'll take a look at everything in terms of, as they should, the buyer. But some of those things could just bring down the value, and that's why I think we alluded to at the beginning of the conversation of, starting to sell and start the process a little earlier, because you can kind of go through all these buckets so that when that time comes, it's smooth, it's easy, everything's kind of checked off, and there's no surprises. But yeah, I feel like usually those owners come in very, very high, and I mean, as they should. It's like it's their baby.
Baby, right?
Yeah.
Like,
No kidding.
Well, good stuff. I feel like I feel like the concept I want to touch on is just sort of an acronym to get ready for for an event, and it's PREP, PREP. So you're going to prep for the event. So P is the P is for Populate. So basically, you need to gather all these documents that the potential buyer want to see, like an operating agreement or bylaws of the corporation, important contracts, leases, different things like that, financials over many years. The R is for review. You want to review these contracts before you open. You want to review and double check that your financials are actually up to date, well prepared, accurate, representative. You want to engage, and the E is for engage your advisors. So tax, legal, finance, IT, HR, whatever. to help you. These individuals, these professionals will help you identify gaps in the process, gaps in what you have, and potential opportunities to remedy those gaps and or add value to the transaction beforehand. So that's a good one. And then finally, plan the integration. So depending on if it's more of a merger, more of an acquisition, there's going to be a post-merger integration roadmap. So that's the kind of the last.
I love that.
P
That's
for
great.
PREP. Anyway,
Well, when you think about it, right, it's like, hey, it's like prep. Like when you hear that word prep, it's like you gotta get ready and prepare. But honestly, that acronym it fits this perfectly. So I love it. I think that's great.
Yeah, well, good stuff. So I think we're going to wrap it up here. I think there's a lot to talk about here, but basically, start sooner, get your financials in order. If there's definitely value added, and I guess the one little bonus, right, of having good financials, even if you don't do if no deal ever happens, is that it'll help you run your business better. That's a nice little, nice
That's
little.
a great point. Yeah, even if there's deal doesn't happen or falls through, I mean, well, you just improved your business, and in theory, could make more money at the valuation. So it's not a bad thing.
Yeah, definitely, that's for sure. All right, well, good stuff. Thanks again for coming, and let us know if you have any questions or other things you'd like us to talk about.
Thank you.